So thank you for calling today. My name is John Stenhouse. I'm the Business Support Manager at the University of Essex, and I'm here with my colleagues, Josh Clark, and with Colin Downing from BDO, the accountants. And Colin is here to talk about tax. So don't be bored, don't worry, it is an interesting subject. Trust me, I used to be a tax advisor myself. This is part of the University Enterprise Zones and Essex County Council's delivery of investment readiness for investors and founders seeking investment. I emphasize this is equally important to both parties to fully understand the implications of preparing to be investment ready, the things you should know, and in particular, tax, how you can use it to your advantage on both sides of the equation. So I'd now like to introduce Colin. Now, Colin is a long-standing presenter in this series and has presented on tax and EIS quite frequently for us. And these are important matters. The enterprise investment scheme or investment readiness scheme, I'll let Colin explain all the different titles going forward. But these reliefs are very important to investors and to founders, because to founders, it could attract the right investors for you. And for investors, it can minimize the risk of your investments and can be quite beneficial when we come to other areas like capital gains tax, etc. But I'm not going to bore you with those details. I'm going to let Colin explain and make them much more fun. So Colin, over to you, please, from BDO. Thank you.
Okay. Thank you, John, and good afternoon, everybody. Thank you for attending this session today. So I'm principally going to talk about the EIS or Enterprise Investment Scheme today, and I'll touch on its younger sibling, the SEIS scheme, which is the smaller brother, if you like, or younger sibling of EIS. I'll talk about what's in it for the investor, plus there are a number of pitfalls, company requirements, including knowledge-intensive companies, and also how you can actually get the relief if you want it. Right. So first of all, background to the Enterprise Investment Scheme. So it's been around since 1994. More than 28,000 companies have now got some EIS investment in it, totaling more than £18 billion. So as John said, it is important, people are using it, and there's a lot of money involved here. The Seed Enterprise Investment Scheme was introduced in 2012, specifically targeting much smaller startup companies. So quite often you'll go through the seed scheme and then move on to the enterprise investment scheme later on. There's also something else that you may have heard of, VCTs or venture capital trusts. I will touch on that a bit later, and that covers everything from startup all the way through to AIM listed companies as well. But the release are not quite so attractive in that one. Okay, so background to the Enterprise Investment Scheme. This is intended principally to encourage investors to invest in equity finance in unquoted trading companies. And in return for that and the risk that you're putting your money to, you will get some tax benefits for it. It provides upside as far as tax benefits are concerned. There is some downside if you don't follow the rules, and because it's a tax advantaged scheme as such, it is approved by the government and the revenue, therefore there are rules that go with it, which I'll get into a little bit later on. It certainly helps unquoted companies to raise equity finance, which is what we're here for today, and solves what the government considered to be a funding gap for smaller and newer companies. Here's a slide that very briefly gives you a summary of the different tax reliefs, etc., that relate to each scheme. So SEIS, for example, you get income tax relief at 50%, EIS is only 30%, and VCTs are 30%, etc. And the other important one there is the capital gains tax exemption. So in SEIS, it's deferral only. For EIS, it's an exemption. And for VCTs, there's no CGT exemption there. So I will cover these in much more detail later on, but that's a very good summary chart which you might want to refer to in the future. Okay, so the investor tax reliefs and the requirements for the investor to be able to access these tax reliefs. So you, first of all, must not be connected with the company in the first place. So before you take out your investment, you must not be an employee. It's possible you could be a director, but there are some more rules which are affectionately known as the business angel rules, which I'll come on to in a minute. And when you do take out your investment, make sure that you don't have more than 30% of the equity in the company. Now, that can be a very important catch because at different stages, you'll have equity being issued. Maybe sometimes equity gets bought back, and you need to keep an eye on that to make sure that at any one stage you don't trip over that 30%, because if you do, it then disqualifies you from all the reliefs that you worked so hard to get. There mustn't be any related investment arrangements. In other words, I'll invest in you if you invest in my company, etc. That sort of thing is not allowed. No linked loans, so similar type of arrangement. I'll give you a loan, or if I invest in your company, you'll give me a loan, that sort of thing. Can't do that. No tax avoidance. So here it's a case of not investing just to get the tax release. It's investing for some other reason. And it's actually quite difficult for the revenue to say, yes, you just invested in this company to get the tax release, but it is possible for them to do that. So you need to be careful and say, no, I think this company is going to do really well. I've got an interest in it, that sort of thing. The tax release are merely to cover the downside should it not work out so well. No value received from the company. So in other words, if I invest in this, you'll give me my money back in 12 months' time. That sort of thing is not going to work. But there are ways that some value can come back from the company, but I'll come on to that in more detail later on. An EIS investor must hold no other shares other than EIS, SEIS, or SITA, which is a special tax relief as well. You'll know if you've got one of those. So the important thing here is if you start out and have some EIS shares or some SEIS shares, then get some EIS shares, make sure you don't get any other normal shares, or as I have seen in the past, someone else who's had EIS shares and they've said, look, I want to cash in, someone want to buy my shares, and other EIS investors said, yeah, okay, we'll buy some of yours because they're EIS shares. When you buy them, they're no longer EIS shares, and that can scupper the release. So I will touch on that and how to get around that possibly later on. There is a tax-free disposal that cannot be claimed unless some income tax relief is claimed, even if it's £1. So this is a trap that came out not so long ago, but basically in order to have a totally tax-free gain at the end of it, you must have got some income tax relief, and I'll come on to that in just a little bit further. So income tax relief for an EIS investment, you can invest up to £1 million. It doesn't have to be in just one company. You can choose a whole raft of different companies, but you get a £1 million investment and you can have 30% income tax relief. So if you invested £1 million, that will be £300,000 of income tax relief. Clearly, if you're going to get that level of tax relief, you need that level of tax that you would otherwise be paying or have deducted from salary or other forms of income. Otherwise, you're simply not going to get the relief and effectively throwing it away. You could invest up to 2 million for knowledge intensive companies. And I'll come on to more about that later on. You do have the option of carrying back the relief that you've got to last year. So an example of where you might do that is if you had lots of income last year that's taxable, but you haven't got that much income this year for whatever reason, then you could carry the relief back to last year. Some people might say, well, why would you do that? Some people do invest towards the beginning of the tax year, so maybe April, May, June time, planning on what's going to happen for the rest of the year, and you might be expecting £1 million worth of income for the year, so you've got investment to make of that, and then a pandemic, for example, comes along, and all of a sudden your income dries up, and therefore you go, okay, I'll carry the relief back and get a relief from last year because I know I had £1 million of income last year. The tax relief limited to the tax liability that you have in the particular year that you're making the claim. So if you're not paying £300,000 of tax on £1 million of investment, then you will not get £300,000 worth of tax relief. So you need enough income with enough tax liability in order to maximize the tax relief that you're going to get. Income tax and capital gains tax exemption, that's what CGT is. So gains on disposal of EIS shares are exempt from capital gains tax. Now, at the moment, if you invest in a company, normal tax rate, if you just invested shares, for example, in ICI, sold those at a gain, subject to your annual exemption, you will pay tax at generally 20%. That might change tomorrow. We'll have to wait and see. But at the moment, it will be 20%. If you've put in a few $100,000 into a company, got EIS relief, and then you sell those shares later on, maybe because it's public listing or it's done really, really well, Google buys it up for maybe £1 billion or something like that. So your gain is absolutely huge. It will be tax-free as long as you have had EIS relief at the beginning and that it's continued for the relevant period of time. If you lose the EIS exemptions, then you'll pay 20% on that gain. So it's quite valuable, and that's often the reason that a lot of investors will invest through EIS, because they get the tax-free gain at the end of it. Of course, it's important that you've claimed some income tax relief from the beginning, and that income tax relief has not been withdrawn, and that's part of the traps. That's what happens when you fall foul of the rules later on. The shares must have been held until the termination date, that's the sale date. Make sure that income tax relief is available when you make the investment and that you've claimed some of that. If necessary, disclaim some of your personal allowance. So if your income is not what you expected for the year, and maybe you've ended up with only a small amount of income for the year, then disclaim your personal allowance and get £1, even if it's just £1 that is covered by EIS relief. Then you will have covered that particular rule, and the gain at the end of the day then will be exempt. Manage income streams here is, if you're going to make an investment in EIS, then plan what your income is going to be so that you maximize the tax relief that you can get. These tax reliefs are out there. The revenue are not going to give them away easily. So if you meet the rules, then you want to maximize the amount of tax you can get back. Where the revenue set up is more about collecting tax from you rather than giving it away. So anytime they are going to give it away, you don't really want to say, no, I don't want it, thank you very much. So plan your EIS investments to match the income tax relief availability that is there. So the CGT deferral relief, which is often referred to as reinvestment relief. So here, investors who have made capital gains in the period 1 year before up to 3 years after you make your EIS investment, you can claim to defer those gains into your EIS investment. So if, for example, you sold a property in that 1 year before to 3 years after your EIS investment, you made a gain on the property. At the moment, you will pay 28% tax on that gain. You could defer that gain, oddly, into your EIS investment that you have made, as long as you've invested enough in there to cover and use the proceeds that you've had from the property. then that 28% gain will then get deferred, and deferred is the important word here, into the shares that you've got. So when you dispose of those EIS shares, although the EIS shares themselves, whatever gain you make on those will be tax-free, that old gain that you've rolled into this investment will then come back, and you'll need to pay the tax on that. It's available even if the investor has more than 30% of the shares. So the 30% limit is there for income tax reliefs, but for gain deferrals, you can put a higher amount in there or have a higher shareholding, and there's no £1 million limit on these. The gains, as I said there, do come back into charge on disposal of the EIS shares. The one to watch out, and particularly with the budget tomorrow, possibly, is a subsequent increase in capital gains tax rates. So if you are deferring a gain that at the moment is taxable at 28%, when it actually comes to be charged later on, you might find that the tax rate at that stage may be higher. Of course, it may be lower, in which case you've improved your situation all over. Deferred gains which qualified for 10% entrepreneurs relief as it was, or investment reliefs, etc. Those reliefs are protected, and so you would still only pay the 10% tax when those gains subsequently crystallize. So losses, we've talked about, all the upside. There can be a downside, of course. If you're investing in a risky company at the beginning, which is inevitably what EIS reliefs are there for, then it might not quite go as we're expecting, and you might lose money at the end of the day. So if you make a loss on the disposal of your EIS shares, now that may not be a sale, it might be wound up because there's, it's just gone to the wall, then you can then claim the loss. Also, by election, the loss can be claimed against other income in the year, so income on which you have suffered income tax. At this stage might be better, depends on your personal situation. So an example here of where the loss might arise and how you might get relief. So if you've invested initially £100,000 in your EIS company, you've got your income tax relief at 30%, so that's £30,000. You've then lost everything else, so it's become worthless. So you claim your loss relief, you can claim the loss, that's the balance of your 100,000 investment after your income tax relief has come off, which in this case would be £70,000. You can claim that against your other income, which if you've got a taxable income over 150,000 at the moment, then that will be taxed at 45%. Therefore, you could get back 45% on that 70,000, so that's 31.5, leaving you with a net loss, i.e. out of pocket, to the tune of 38,500, which is not as bad as putting in your 100,000 at the beginning and losing all of it. So it's reasonably generous from that perspective. Inheritance tax is often something that's considered in relation to EIS, and in particular business property relief. This is another reason why some people do invest in EIS companies. Any company that qualifies for EIS should also get business property relief at 100%. So in your estate, if you've invested money into shares, the value of those shares when you die should be covered by business property relief, providing you've held those shares for at least 2 years. And therefore, it reduces the inheritance tax liability on death to nil on those EIS shares. Seed Enterprise Investment Scheme, so this is the younger sibling of EIS. It was specifically put in place back in 2012 to cover early startups, so even more risky than Enterprise Investment Scheme, but there's a bit more generous tax reliefs to obtain from this scheme, but it's more limited. So the income tax relief available is at 50%. That's despite the fact that your top income tax rate is at the moment 45%. So if you invested £100,000 in a seed scheme, then you would get £50,000 of income tax relief potentially. Now, providing you have paid or have a tax liability of at least £50,000, so your income would obviously need to be more than £100,000 to generate that level of income tax charge, then you would get that £50,000. So it wouldn't just be 50% of your tax bill, it's 50% of the investment, and that effectively goes against whatever tax bill you have for that particular year. It is available against in that tax year of the share issue, or you can carry it back to the last year if that works for you. Here, the maximum investment you can make is only 100,000 per year with the 1 year carry back as well. It's obviously for smaller companies, as the question leads you to believe it's less than 2 years old. The issue here is potentially you may have created your company more than 2 years ago and it's simply been dormant for a couple of years. Particularly at the moment, perhaps with the pandemic, you might have created it at the beginning and then thought, yes, we'll get going. Then the pandemic hit and you thought, whoa, no, let's stop for a minute, wait for the pandemic to get out of the way, and then we'll start up. Otherwise, it's just going to be a drain on resources at the moment. So where you have got a company that was more than 2 years old, correctly, if the business has been going or the activity has been going for less than 2 years, then that's perfectly okay. But you just need to make sure that you're ready for the revenue to ask, well, your company's 4 years old now. What's going on, and be able to provide evidence that there was nothing going on for 2 years or more, and that your business has actually only been operating for less than 2 years. Here, again, there's capital gains tax exemption on sale, and slightly differently to the EIS scheme. In this particular one, you can reinvest other gains up to 50% of those gains into the seed investment. Now, this is not a deferral. So if you have a gain, for example, of £20,000 and you've invested much more than that into the SEIS scheme, then you can physically reinvest half of that gain effectively into your SEIS investment, and that gain goes away. So you would only effectively pay tax on the other half of your gain in this particular year. And that's given in the same year as the income tax relief. I referred earlier to certain situations where you might get some money out if you follow the Business Angels rules. And that's what I'm going to talk about now. So certain company directors would normally not qualify for EIS relief unless they meet the Business Angel rules, and they are fairly restrictive. The two options to qualify as a business angel in this situation is that you're unpaid or not entitled to remuneration, or were not a director before the first EIS investment was made, and that you meet certain other conditions. Now, unpaid directors can still qualify for EIS, and providing that they're not remunerated or not entitled to remuneration. But there are still some payments that are allowed to be made. So if you incur necessary out-of-pocket expenses, then you can expect to be reimbursed for that. So that's not unreasonable. That would be fine. Equally, if the company is operating from one of your properties, for example, then you can be paid a commercial rent for that. No problem with that at all. And if the company buys goods from one of your other businesses, again, no problem with that. Remuneration can be given for services, and this is a bit of a mouthful, but it is paid for services rendered in the course of a trade or profession other than secretarial or managerial services, or services of a kind provided by the person to whom they are rendered, and is taken into account in calculating for tax purposes profits of that trade or profession. Now, in English, what that means is if you have a company that's, for example, the SEIS or EIS company that is an estate agent, and you happen to be a plumber, if that company needed you to come in and fix a leaky pipe or something like that, that's fine. But if you also happen to be an estate agent and they're an estate agent, then that doesn't work. So if you're in its same business as them and providing therefore the same or similar services, then that won't be allowed. But if it's something totally different, then that's absolutely fine. The other thing there is payments to connected persons, including a personal service company, are treated as payments to the investor and could also be receipts of value leading to the loss of EIS relief. Now, this is a very important point because you need to be very careful and clear as to who connected people are. And one of the traps that I have seen here is an individual who was an EIS investor. He'd been invested in the company for a couple of years, was not a serial investor, so didn't really know the rules inside out and backwards. And his grandson came up and said, I could do with some holiday work. Do you know anyone that could help with this? And he said, well, yeah, I know the company, a company I've invested in. They can do some of that for you. And he then arranged for a couple of weeks during the summer holidays, a couple of £100, and that then meant that his entire EIS relief was lost because it was a connected person that he had arranged a couple of £100 worth of holiday work and therefore was treated as, in effect, a payment to the investor, and therefore he lost the EIS tax relief. So that was not good news in that situation. So you need to be really careful of that and to make sure that you don't fall foul of those particular rules. So paid directors qualifying for EIS, those individuals must not be remunerated or entitled to remuneration before their first EIS investment. Once they have become paid and or entitled to remuneration, then they can make further EIS investments, but there is a time limit, and that's 3 years from the last EIS investment before they became paid. So the example we have here is 1st of April 2020, the EIS investment was made and shares were issued. So he's then got 3 years from that date, effectively, as the final date for him to make any further EIS investments that he wants to make. If he goes beyond that date, even though the company might be EIS qualified, his will not qualify for EIS relief. No non-qualifying shareholdings requirement. So in order to claim EIS relief, an investor must not hold any other shares which are not EIS shares. So if you have any other holding in that company of non-EIS shares, then you won't get EIS relief. Now that tends not to be the problem at the beginning when you go for your EIS investment, but as I mentioned earlier, it might be a problem later on when you want to buy someone else's shares, whether they were EIS or not, and you think they retain the EIS. No, they don't, and therefore it becomes a problem. So be very careful there. What I would suggest, if there are others who are selling their shares, then you might want, for example, your wife, if that's possible, or husband, to acquire those other shares so that your investment in the EIS is not disqualified by doing that. So EIS shares must be a subscription for new shares that are fully paid for in cash, perhaps not physical cash in this day and age, but certainly a payment that is for those new shares to be issued by the company. So that would not be the case where you're buying shares from somebody else. An EIS relief is not available if you buy shares from another investor, as I've just said. So I mentioned earlier associates, and what do we mean by associates? Associates, individuals will be disqualified if they or an associate, which is a business partner or family member, is an employee or director of the company. So in this situation, you don't want a business partner from another partnership also being a member in this particular company. Or if they are, then you need to be careful on the 30% shareholding total not being exceeded when you add the two of you together. Shareholder who invests, for example, £100,000 in company A, as I mentioned earlier, his grandson needed some work experience, so he had a word with the chairman's ear, and he basically blew his £30,000 tax relief for the sake of a couple of £100. So that's in the slides there, if you need a reminder later on. So some of the pitfalls for the income tax reliefs. There are a lot of very detailed rules, as is probably clear from what I've already said. Investors and associates can't have more than 30% of the share capital. Can't be an employee subject to the business angel rules. The responsibility doesn't end with just getting the investment and paying your money over and getting your shares. You need to keep that under review, and that's often where things do go awry. And that needs to be kept under review for a period of 3 years after your investment is made. The company also needs to keep an eye on what it actually uses the money that it gets for EIS and what it uses those funds for. It has to be employed and used in the business for a qualifying purpose. Another thing that needs to be carefully considered is the timing. So the company will obviously get cash from different people. It collects it all in and then issues the shares. It all needs to be done at the same time. So the payment of cash coming in can all sit in a separate account, waiting for the point at which you're going to issue the shares. And when a company's out there looking for a certain level of investment to come in, you may well get some people who say, yeah, I'll buy the shares, and then they just take forever to put their money in the company. And at some point, someone may say, well, look, we just need to get on with this. We've got the money earmarked for various things. We'll draw the line now. And lo and behold, Mr. X has not put his money in yet. So at that point, you draw your line, you say, we've got this cash in, you've issued your shares, away we go, guys. So all of those people will get their EIS relief. And then along comes Mr. X later on and says, oh yeah, here's my £20,000. They need to be very careful because that may well not qualify for EIS because he hasn't come along and got his shares at the same time. So he might need to wait for a second issue to do that. Also need to be very careful as far as the company is concerned in what it does and how it goes about its business. So initially, when we will get EIS relief, it'll have a business model. It'll be planning on doing various things and developing its business, and that can change. Now, if it changes as a development type model might do, then that's generally fine. But if there's a significant shift, so if it says, yeah, we're planning on manufacturing widgets, and then it changes to manufacturing cardboard boxes or something entirely different, then that can mean that the company no longer qualifies, particularly if it moves into an area of trade which is on the list of specific ones which are not allowed and don't qualify for tax relief. So you wouldn't want them to become an accountant, for example, because that would disqualify them. You need to be careful with any restructuring. So as a company grows, then it might wish to restructure to make it work better. So we need to be careful there how that restructuring takes place and what's done and how it's undertaken. Interaction with other share schemes, again, need to be quite careful as to how that works. In this particular case, with any of the above, if you've got any concerns, then talk to your own tax advisor, or in the company's case, they really do need to talk to their professional advisors to make sure that they're not going to have lots of angry EIS shareholders banging on the door the following day. So qualifying companies, the basic rules here, because the tax reliefs are pretty generous, it's not surprising that there are some complex rules that go along with it, and that the company needs to qualify in order to get those sorts of reliefs available for the investments. As I mentioned, it needs to be an unquoted company. In this case, an AIM listed company is unquoted for these purposes. It must be a trading company, i.e. not an investment company. Age can be important, so I will come on to that in a minute as to why it's important, particularly even for EIS companies. There's a gross assets limit here, 15 million, so the company mustn't have gross assets of more than 15 million before the EIS investment and 16 million afterwards. And I hasten to add, it's gross assets, they're not net assets. Most people look at the bottom line of net assets. It's not, it's gross assets. Independence and qualifying subsidiaries. So there are some restrictions on certain subsidiaries. So we need to be careful with those. There are some limits on the number of employees that you can have. And as already mentioned, there are certain excluded activities which EIS does not apply to. So at the top there, I've put the age of the trade. For SEIS, I mentioned 2 years. For EIS and VCTs, it's 7 years. And for knowledge intensive companies, that extended to 10 years. And that basically means in the first 7 years of the business operation, the company must go out for and get some EIS investment if it wants to have a second round later on. If it's gone out there and got it in the first 7 years, then that's fine. You can then, there's then effectively no time limit. There will be the other limits that apply, but there's no time limit. If you come along in year 8 and not having had any EIS investment before, then you will not qualify, no matter how well structured it is and how it all fits with all the other rules. If it's more than 7 years old, it will not qualify for EIS relief. As I mentioned just now, gross assets rules, figures are there. Number of employees for EIS has to be under 250. That's in effect 250 full-time equivalents. So you might have more than that as part-time individuals, but it's full-time equivalents. And the maximum investment in the company is 12 million, but only 5 million in a 12-month period. So for EIS, that is. And then the maximum investment per individual is £1 million. Details for knowledge intensive companies are on the right of that. And then SEIS, as I mentioned earlier, the figures are somewhat lower. Okay. So the age requirements, as I mentioned earlier, for SEIS companies needs to be under 2 years old. So that's measured from when the company commences trading. So you just need to be careful so that you can explain that if the company is actually older than that. For EIS and VCT companies, needs to be under 7 years. That's measured from the first commercial sale. And the first commercial sale is any sale other than limited sales to test the market. So should be pretty obvious there. Exceptions do exist for follow-on funding. So providing you've done your first investment in the first 7 years, then the rest hasn't got the time limit. And geographic market, if you change your geographic market, and the way the revenue interpret that now is getting wider and wider, so do be careful of that one. And knowledge-intensive companies must be less than 10 years old the date the first block of shares are issued. And that again is from the first commercial sale or the end of the accounting period in which their turnover reached 200,000 per annum. SEIS companies must have gross assets of less than £200,000 at the date the shares are issued. Again, that's gross assets, not net assets. And watch here, particularly the valuation of any intellectual property that may have been brought in, because quite often IP is on the balance sheet at next to nothing. But if it's worth quite a bit, then you could find that you're over the £200,000 limit. Again, for EIS and VCT companies, gross assets, and where you have a group, you need to add up the assets of each group company and then remove the intergroup investment. So it's a bit like a consolidation calculation there. But you do need to be careful not just to use the consolidated group balance sheet, as that can be misleading. So you need to get someone to check on that. Excluded activities, as I mentioned earlier, it applies across the board here for all the different schemes. So dealing in land, shares, futures, that's various investment activities in effect. Banking, accountancy is in there. Farming and market gardening, that's really because there are some quite nice tax rules for farmers, so that's different. Property development, etc., is generally investment or regarded as investment activity. Coal, what's left of it, and steel production, shipbuilding, generation of electricity, gas, etc., is excluded, and providing services to connected party conducting one of the above trades. So watch out for those. If you're not engaged in any of those trades, then that's fine. You should be okay. License fees. So the receipt of royalties and license fees is an excluded activity unless the company issuing the shares has the greater part of the value of the IP, generated the greater part of that IP itself. So when you start out, you might design something which you then get a patent on it or something like that, and then effectively license someone else to do that activity somewhere outside of your main trading area. And that's probably okay, but you do need to be careful of that. There is a 20% tolerance here, so it's not a case of £1 of disqualifying activity messes everything up. So a company which carries on an excluded activity together with its qualifying activities, the excluded bit, providing it's less than 20% of the company's overall activity, then that's fine. Well, you say, what's overall activity? Well, not surprisingly, the revenue will choose which one they wish to look at. And generally, surprise, surprise, it'll be the worst one out of a selection of turnover, profit, assets employed, level of activity, etc., that your staff are working towards to generate the income or profits that disqualifying part has in the company. Now, providing they're all under 20%, then that's not a problem. But just be careful because you might find that although your turnover and profit from a disqualifying activity is less than 20%, the staff that are working on that work out to be more than 20%, and therefore that could be a problem. So some of those hidden areas can be problematic. And as I say, the revenue will look at the worst one. I mentioned earlier 3-year qualifying period. So in order to secure the tax release, you've got to hold your shares for at least 3 years. And all the rules that I've talked about earlier on for qualifying for that relief, both for investor and the company, need to be constantly under review for those 3 years and stick within the rules during that time. That can be an issue where for example, certain things change over that period, and invariably what will happen is at the beginning, when everyone's talking about getting the investment, issuing the shares, everyone's fully au fait with the rules, and then they get forgotten tomorrow. And 2 years down the road, you start doing something that you shouldn't be doing. There are a couple of tests there which only apply at the date the share issue is made, and that helpfully is the number of employees and the gross asset test. So as long as you meet those rules at the time of issue of the shares, then it doesn't matter what happens tomorrow or further down the road. And clearly that's quite reasonable, because if a company gets some EIS investment and takes off and does really well, you don't want to be holding it back for 3 years because you don't want to go over one of those two tests. So you don't need to worry about those tests. They only apply at the date of the share issue. One of the other traps perhaps sometimes is companies cannot be trading in partnership or as joint ventures can also be problematic, because that can be like a quasi partnership. So beware of partnership agreements. If it looks like a partnership, then you need to tread very carefully at the end of the day. If the company's just doing its own stuff and doing it all for itself, then that's fine. You don't need to worry about it. Okay, one of the areas that the revenue tweaked the rules probably 4 to 5 years ago now is the risk to capital requirement, because there were a number of dare I say, tax avoidance schemes that were out there that were purporting to get you EIS relief for investing in certain companies, and there wasn't really the risk to your money to any great extent. So the companies now need to demonstrate that there is a genuine risk on the capital that you invest. So in other words, the investments could go belly up. The company in which the investment is made must have objectives to grow and develop over the period of time. And the investment must carry a significant risk that the investor will lose more capital or lose their capital that they have invested, including the tax relief. So in practice, it shouldn't be an obstacle, certainly for early stage companies, because you're going to have views of trying to grow. You'll have your business model, it's going to have growth in there, you'll have your cash plans, etc. And entrepreneurial trading companies inevitably operate in that way as well. So there really shouldn't be an issue for genuine companies that are looking to get this type of investment off the ground, and early startup companies. So as I mentioned earlier, there are some more generous age and size limits for knowledge intensive companies. So what is a knowledge intensive company? It must have had 15% of its costs spent on research and development in one of the last 3 years, or 10% of costs spent on R&D in each of the last 3 years, and engaged in work to create intellectual property. And it will be reasonable to assume that within 10 years, most of the company's activity will be exploiting that IP. It has to have at least 20% of the workforce skilled employees, as in having a master's degree, relevant usually to the R&D activity. I'll talk here as well about advance assurance. So one of the things that companies certainly are nervous about, and investors tend to be as well, is trying to make sure that before you put your money into the pot, you're actually going to get the tax reliefs that I've talked about earlier on. And the revenue offer an advance assurance to do that. The company will normally apply for that. It's not compulsory, but generally companies will do it. Oddly now, if you don't apply for advance assurance, then everything you would have done to do that advance assurance, you need to do when you actually do the main application to the revenue anyway. It includes lots of information about the company, what its growth plans are, what it's going to use the money that it's going to get from the EIS subscriptions, etc., and who the investors are likely to be. as well as convincing the revenue that it meets all the conditions that it has for these schemes. So it includes business plan, financial forecasts, budgeting, company articles, shareholders agreements, and a list of the investors as well, which can be problematic sometimes. So after the share issue, the company needs to submit either an SEIS or EIS1 compliance statement. These are all now done online, and then the revenue will, if it's happy, will then issue a next block of documentation to the company, which will include the forms that the company needs to fill in with some basic information about the company, the investment that's been made, when it's been made, and then give that to the investor, who then uses that to claim his personal tax relief. Whether you want your capital gains deferral or your income tax relief, etc., that's the form that you will do that on. EIS and VCTs, SEIS are a form of state aid. So there are certain limits on that. I won't go into too much detail. Will the rules be abolished? 3rd of March is a little old now. It'll be tomorrow, possibly. Might be abolished. I think he might extend it, but we'll have to wait and see. It depends how deep his pockets are. We'll have to wait and see. And that's all I've got to say at this stage. So you said, Josh, there are a number of questions that we have.
In terms of a business being trading or open for business, so this example says that they registered on Companies House in February of this year, and the MVP became ready just this month. So can they say that they were open for business from October, or do they have to use the date of registration in February?
So you wouldn't need to use the date of registration. The registration date is clearly the safety stop. So the revenue can't say that you've existed any longer than that, because clearly it hasn't. But if it becomes an issue later on, particularly for SEIS, for example, then you need to do that within the first 2 years. So if you needed to use your activity date as this month, then yeah, use this month. But I'd try and get your investment in within 2 years of incorporation, because then you're not going to get any arguments from the revenue as to timeline then.
Okay, thanks, Colin. So there's a couple here on advanced assurance. So the first one being, so there's a company that are currently going for advanced assurance for SEIS.
Yep.
So if they're accepted, does that automatically give them advanced assurance for EIS, or they have to do something, the additional application for
that? You probably wouldn't need to do an additional assurance for EIS, providing you continue to do the activity, etc., that you're doing at the moment. So if your activity changed, for example, and you started doing something else or expanded into new areas, then you might need to be careful about that, or wish just to make sure later on. But you know, as things grow and you get to a point when you want EIS relief, then as long as you're not exceeding the gross assets and the employee numbers, then you wouldn't have any problem with getting further clearance, advanced assurance on that. What we tend to find, although it's not necessary to get advanced assurance, it does oil the wheels of motion much more if you do get it. And you find that the revenue will be much quicker in sending out your documentation, having done the investment. When you submit to the revenue, send in the EIS1 or SEIS1. If you've got an advanced assurance, the paperwork will come back much more quickly than if you haven't, because then they've got to sit there and go through it. And all the time that they would have done that doing the advanced assurance, if they've already got it in front of them, they haven't got to worry about it.
Cool, thanks, Colin. So the other one there about the advanced assurance was about the list of potential investors that has to be on the advanced assurance.
Yep.
So the question is, can you confirm whether the potential investors listed actually have to be committed to the investment, or can they just be speculative? Exactly. Almost?
They can be speculative, and this question probably gets asked every time I have a discussion about this. And invariably what tends to happen is a number of speculative investors will be put, their details will be put down, and then others will come along later on as part of that round of investment. Or indeed some of them will drop off, but you just need to put some down there. So the real reason for that is that revenue wants to know that you're serious about getting some investment in, and you're attractive enough to actually attract certain investors to think about investing in your business, and that you've obviously done something by way of documentation, business plans, etc., that are presentable to potential investors. So it kind of makes it more legitimate, and suggests that you've done your homework to get things moving, rather than it's all on paper and you actually haven't done anything yet.
There's another question related to one of the earlier questions in regard to the time when the clock starts ticking really on your SEIS, whether it's when you're incorporated, receive your first payment from a customer, or paid contractor. So do you have any more comments on that?
So ultimately it's you're going to be looking at probably your first sale as the obvious activity, but you might find that costs have been incurred before that in buying bits and pieces to do whatever it is you're going to do. So that could be argued as being the commencement of your activity. As I said earlier, if it doesn't matter that the date of incorporation is less than the 2 years, then it's really not an issue. So I'd try and protect yourself from that point. But if it becomes important, then have your evidence lined up to say, no, activity started on this date, and here was the first payment that I made, or here's the first bit that I did by way of activity. So therefore, my commencement activity date is this date here. It's often difficult to go back and find or determine that date after the event, when suddenly you're asked for that information. So try and have it now, so that, and it's stored, locked away in a drawer or something, so that you've got it ready to give to the revenue if they come along and ask that question.
One of the questions here is, if someone has shares in my company, can they sell them and then buy EIS shares?
Yes, in a word, providing their shareholding isn't at the moment, or hasn't been, above 30%, because the revenue will look at that. But if one of the ways of doing it is to sell your shares, you might make a gain on those shares now and then make a separate subscription for EIS shares. But you need to leave the sale and the subsequent acquisition needs to be at least 30 days apart. Otherwise, for tax purposes, they actually marry up the purchase with the sale. So you need to leave some time there. If it's an issue and you've got a partner that you can trust, then get the partner to do the EIS acquisition if you can, because it just saves the hurdles that you're having to go through to get it.
Is it a requirement, the advance assurance for SEIS and EIS?
No, it's not a requirement. You don't have to have it. But as I said earlier, if you don't do it, you're going to have to do everything that you would do for an advance assurance when you actually make the application. So the revenue will expect all of that documentation, information, etc., plus the other bits and pieces that you need to do when you do the full application anyway, and it takes longer to come through. What you'll find is it will take probably a couple of months longer to come through, and invariably your investors get a bit nervous. Your investors will be hounding you to say, have you got it through yet? Have you got it through yet? So the shorter time that you can do for applying formally for the release and getting the forms back, the better you will find it. So if you do get an advance assurance, you will find that it will be much quicker and much less hassle and aggravation for you when you're trying to run the company and you've got investors on the phone all the time saying, have I got the forms yet or not.
That makes perfect sense, really, doesn't it? So if you're going to go for it, you might as well go for the advice
It's
assurance.
not, and I know certainly some companies in the early stages, they are watching pennies like a hawk. And asking a professional advisor to do the advance assurance, sometimes they think, well, that's money down the drain, but actually it isn't, because you've got to do that anyway, even in the main application.
There was just one little question there. It was from Sam. Do you mean no other shares in the company? Which you actually answered during the course of the presentation. But I will just reiterate, it was in fact the amount of EIS shares in that one company, not in many companies.
Not many, no.
So it was all focused on the amounts are all focused on one company. Colin, thank you very much. BDO, once again. I can only reiterate that clearing up the mess when you make mistakes when you're setting up a company are going to cost you both in time and money, and an awful lot of stress. So if you want to avoid the stress, the time, and an awful lot of money, then spend a little bit of money and get the right advice at the very beginning. And I will thank you all for attending today. I welcome you to join us on our next set of webinars. Watch out on YouTube for the pre-recording and the recording of this event as well. And I wish to thank Josh and Colin for an excellent presentation today. Thank you so much, and goodbye.